73% of people in their 30s right now will never have enough money to retire comfortably. Not because they don't earn enough, because they're following the wrong investment strategy for their decade. A 35-year-old investing the same way as a 55-year-old is leaving millions on the table. Here's the decade-by-decade strategy that actually builds wealth. Let's start with your 30s, because this is where everything changes. If you're 30 right now and you invest $1,500 per month with an average return of 8%, you'll have $2.3 million by 65. Wait until you're 40 to start? That same monthly investment gets you just over $1 million. Your 30s aren't important, they're everything. Here's your exact allocation for your 30s. 85% stocks, 15% bonds. That's aggressive, but you have 30 years to recover from any crashes. Within that stock allocation, do this. 50% in a total market index fund like VTI or Vanguard Total Stock Market, 20% in international stocks through VXS, 15% in growth stocks through QQQ or VUG. The remaining 15% in bonds goes into BND or a total bond fund. But here's what nobody tells you about your 30s. Max out your Roth IRA first. Not your 401k, your Roth. That's $6,500 per year in 2024, going up to $7,000 in 2025. Why? Because Roth money grows tax-free forever. A 32-year-old who maxes out their Roth IRA for just 10 years and never contributes again will have more money in retirement than someone who starts at 42 and contributes for 20 years. The math is insane. After your Roth, hit your 401k up to the company match. That's free money. If your company matches 4%, contribute 4% minimum. Then open a regular brokerage account at Fidelity, Schwab, or Vanguard and invest everything else there. Why? Because you might want to retire before 59 and a half. Money in a brokerage account can be accessed anytime without penalties. Your 30s are also when you buy your first rental property if that's your path. A $200,000 property with 20% down in a decent area can generate $400 to $600 per month in cash flow after expenses. That's passive income that grows with rent increases and you get the tax benefits. But only do this if you have 6 months of expenses saved and your high-interest debt is gone. Now let's talk about your 40s. This is the acceleration decade. Your income should be significantly higher than your 30s. Maybe you got promoted, maybe you switched jobs. Either way, this is when you pour gasoline on the fire. Your allocation shifts slightly. 80% stocks, 20% bonds. You're still aggressive, but protecting a bit more of what you've built. Here's the critical move in your 40s. Increase your savings rate by 1% every single year. If you're saving 15% of your income at 40, you should be saving 25% by 50. This is easier than it sounds because your income is growing. Every raise you get, save half of it. Spend the other half. This way, you still feel progress in your lifestyle, but your wealth compounds faster. Your 40s are also when you should max out both your 401k and your Roth IRA. The 401k limit is $23,000 in 2024. The Roth is $6,500. That's $28,500 total in tax-advantaged accounts. If you're married and both spouses do this, that's $57,000 per year growing tax-advantaged. Do that for 20 years and you're looking at $3 to $4 million just from those accounts. But here's where most people in their 40s screw up. They start getting conservative too early. They see one market crash and panic into bonds. Don't do this. You still have 20 years until retirement. Stay aggressive. The 2008 crash? People who stayed invested made all their money back by 2012 and then doubled it by 2020. People who sold and went to cash? Many never recovered. Your 40s are also when you consider a mega backdoor Roth if your 401k plan allows it. This lets you contribute up to $46,000 total to your 401k through after-tax contributions that you immediately convert to Roth. Not every plan allows this, but if yours does, it's a game changer. Call your HR department and ask. Now your 50s. This is your peak earning decade. You're at the top of your career. Your expenses might actually be dropping if your kids are becoming independent. This is when you go all in. Your allocation, 70% stocks, 30% bonds. You're getting closer to retirement, but you're not conservative yet. The big advantage in your 50s? Catch-up contributions. Once you hit 50, you can put an extra $7,500 into your 401k. That's a total of $30,500 per year. Your Roth gets an extra $1,000. Use every penny of these catch-up contributions. This is your last chance to really build wealth. Here's what wealthy people do in their 50s that others don't. They pay off their mortgage, not because debt is bad, because eliminating your biggest expense before retirement gives you flexibility. A 52-year-old who pays off a $300,000 mortgage reduces their retirement income needs by $15,000 to $20,000 per year. That means they need $300,000 to $400,000 less in their retirement accounts. Your 50s are also when you start thinking about withdrawal strategies. How will you actually access this money in retirement? You need money in 3 buckets: tax-free money in your Roth, tax-deferred money in your 401k, and taxable money in your brokerage account. This gives you flexibility to manage your tax bill in retirement. Now your 60s. This is the transition decade. Early 60s, you're still working and saving. Late 60s, you're retired and withdrawing. Your allocation shifts to 60% stocks, 40% bonds at 60. By 65, you might be at 50-50. Notice you're never going below 50% stocks. Even in retirement, you need growth to outpace inflation for 30 years. At 62, you can claim Social Security, but don't. Every year you wait until 70, your benefit increases by 8%. That's guaranteed. No investment gives you guaranteed 8% returns. If you can afford to wait, wait until 70. A person claiming at 62 might get $1,900 per month. That same person waiting until 70 gets $3,300. Over a 30-year retirement, that's a $400,000 difference. Your 60s are also when you do Roth conversions. You've retired at 63, but you're not taking Social Security until 70. Your income is low. This is when you convert money from your traditional IRA to your Roth. You'll pay taxes, but you're in a low bracket. Then that money grows tax-free forever. This is advanced, but it can save you hundreds of thousands in taxes. Here's the biggest mistake people make across all decades. They try to time the market. They think they'll sell before crashes and buy before rallies. Study after study shows this doesn't work. The average investor returns 4 to 5% per year. The S&P 500 returns 10%. Why the gap? Because people panic and sell at the bottom. Stay invested through crashes. Keep buying. When the market drops 30%, you're buying stocks on sale. The wealthy get wealthier in crashes because they keep buying while everyone else panics. One more thing. Automate everything. Set up automatic transfers from your checking to your investment accounts on payday. You can't spend money you never see. People who automate their investments save 3 times more than people who invest manually. It removes emotion and discipline from the equation. If you're watching this and you're behind, don't panic. Start now. A 45-year-old who starts investing $2,000 per month can still hit $1.2 million by 65. A 55-year-old investing $3,000 per month can hit $600,000. It's not too late, but it will be if you wait another year. The path to wealth isn't complicated. Max out tax-advantaged accounts. Invest in low-cost index funds. Stay aggressive until you're within 10 years of retirement. Never sell in a panic. Increase your savings rate every year. That's it. Boring but effective. The people who retire as millionaires aren't special. They just followed this strategy for 30 years while everyone else jumped from trend to trend. Be boring. Get wealthy. That's the formula.